Ever wondered about the potential of mid-cap funds in diversifying your investment portfolio? Today, we delve into the world of Vanguard's mid-cap funds, a collection of investment options that strike a balance between growth and stability. Firstly, we have the Vanguard Mid-Cap Growth Index Admiral, or VMGMX. As part of the renowned Vanguard Group's investment suite, this fund is an incredible option for those who are looking for strong investment performance and a trusted name in the financial world. The fund's main objective is to seek long-term capital appreciation, a term that may be unfamiliar for some. To elaborate, capital appreciation is the rise in value of an asset or an investment time, something this fund has consistently managed to achieve through its focus on mid-cap growth stocks. It is worth mentioning that mid-cap stocks are the shares of public companies with a market capitalization between $2 and $10 billion. These stocks form a significant portion of the financial market and are often considered to be a bridge between small-cap and large-cap companies. Now, when we talk about the Vanguard Mid-Cap Growth Index Admiral, it's impossible not to mention its impressive compound annual growth rate. Standing at a strong smile, this figure reflects the average annual growth rate over the past 12 years. This is according to the back-tested data from the article below, assuming the profits were reinvested at the end of each year. This percentage showcases the ability of the fund to consistently deliver solid returns on investments, a characteristic that is often sought after by seasoned and novice investors alike. When it comes to analyzing the performance of the fund, it is important to look at the standard deviation, which for this fund is 17.02%. Standard deviation is a measure of the dispersion or variability of a set of values. Here, it tells us the fund's returns have fluctuated around the mean return of 12.06% by approximately 17.02%. This is a vital tool in understanding the fund's volatility and the risk associated with the investment. It's worth noting that the best year for the Vanguard Mid-Cap Growth Index Admiral saw an incredible return of 34.48%. This year marked a period of exceptional growth and profitability, highlighting the fund's capacity for high returns. On the contrary, the worst year brought a negative return of -28.84%. Despite this setback, the fund remained resilient, adapting strategies and working towards recovery. It is important to remember that all have ups and downs, and it's the resilience during the downtimes that sets the best funds apart. Despite the volatility of the markets and the inherent risks involved in investing, the Vanguard Mid-Cap Growth Index Admiral maintains an impressive Sharpe ratio of 0.69. The Sharpe ratio, named after Nobel laureate William F. Sharpe, is designed to help investors understand the return of an investment compared to its risk. A ratio of 0.69 indicates a solid risk-adjusted return, demonstrating that the fund has successfully balanced potential returns against the level of risk. To top it all off, one of the most appealing aspects of the Vanguard Mid-Cap Growth Index Admiral is the fund's expense ratio, which stands at a mere 0.7%. The expense ratio is essentially the cost of the fund, divided by the total assets of the fund. A low expense ratio like this one makes the fund an even more attractive investment, as it ensures that more of an investor's money goes towards the investments rather than being eaten up by administration costs. The fund's expense ratio stands at a mere 0.07%. Next in line is the Vanguard Extended Market Index Admiral, or VEXAX. Providing exposure to the entire U.S. stock market, excluding large-cap stocks, it has a compound annual growth rate of 11.27%. The fund's best year saw an impressive 38.37% return, while the worst year witnessed a -26.47% return. The fund's Sharpe ratio stands at 0.61 and the expense ratio is 0.07%. Our third contender is the Vanguard Mid-Cap Index Admiral, or VMAX. This fund aims to track the performance of the CRSP US Mid-Cap Index, representing mid-cap stocks. With a compound annual growth rate of 11.67%, a best year return of 35.15%, and a worst year return of -18.71%, this fund maintains a healthy Sharpe ratio of 0.70. The fund's expense ratio is 0.6%. Lastly, we have the Vanguard Mid-Cap Value Index Admiral, or VMVAX. This fund seeks to track the performance of the CRSP US Mid-Cap Value Index, emphasizing mid-cap value stocks. It has a compound annual growth rate of 11.6%, with the best year return reaching 37.6% and the worst year return at minus 12.42%. The fund's Sharpe ratio stands at 0.66 and the expense ratio is 0.05%. Now, how does it stack up to common benchmarks like the S&P 500 VFIAX and the top 100 in the NASDAQ, otherwise known as QQQ? Well, for starters, although the best performing mid-cap fund was growth-oriented, being heavily weighted towards technologies, QQQ outshined it by almost 2 times over the same period for an expense ratio of 0.2%, compared to the growth fund having only 0.07%. Within the backtest from the article below, that would have represented a difference of about $40,000, assuming that you invested $10,000 into each fund at the same time. Then when you take a look at the maximum drawdown those funds have experienced during that time, QQQ had a similar drawdown of 33%, which means for the same volatility and risk, you would have had twice the returns. Even worse yet, the S&P 500 kept up with that mid-cap fund and surpassed it over time, especially during the market correction of 2021 and 2022. In summary, Vanguard's mid-cap funds offer a unique blend of growth potential and relative stability. While they may not match the risk-adjusted profiles offered by some larger market players, their appeal extends beyond maximizing returns. Mid-cap companies often represent a sweet spot between the stability of large-cap entities and the growth potential of small-cap counterparts, making them a valuable addition to any diversified investment portfolio. That is, of course, if you don't explore other types of funds that might give you more value for the volatility you're taking on and the risk of putting your money in the marketplace.